Right now, while most people are distracted by headlines and politics, something extraordinary is unfolding beneath the surface of the global financial system. Because the collapse of a nation most investors barely watch has quietly ignited one of the most explosive moves in the silver market in decades. And if you own gold, silver, or even just paper money, what's happening next could matter far more than you realize. Venezuela's collapse is not just another tragic story of mismanagement and sanctions, it is a live case study of what happens when trust in a currency evaporates, when production implodes, and when hard assets suddenly become the only form of truth people believe in. And that is exactly why silver has begun to rocket in ways that are making seasoned market veterans uneasy and deeply attentive at the same time. To understand why silver is moving the way it is, you have to start with Venezuela not as a political headline, but as a resource giant that once sat on some of the largest proven reserves of oil, gold, and industrial metals in the world. For decades, Venezuela functioned as a warning sign economists referenced in textbooks, but markets largely ignored it, because the damage seemed contained, distant, and manageable. That illusion shattered when the nation's economic system finally collapsed under the combined weight of hyperinflation, currency destruction, production failures, and geopolitical isolation. When a country rich in real assets becomes poor in credibility, the shockwaves do not stay local. They ripple outward into global supply chains, commodity pricing, and investor psychology. Silver sits at the crossroads of all of this. Unlike gold, which is primarily a monetary metal and store of value, silver is both money and machinery. It is used in solar panels, electronics, medical devices, defense systems, and increasingly in green energy infrastructure. When a major resource region becomes unstable, it doesn't just reduce supply, it injects uncertainty into future production forecasts. Markets hate uncertainty more than bad news, and Venezuela represents uncertainty at scale. Silver prices don't simply rise because supply tightens, they rise because no one can confidently model what supply will look like 6 months or 6 years from now. Historically, silver has always lagged gold at the beginning of precious metals bull markets, only to dramatically outperform later. This pattern showed up in the 1970s inflation crisis, again in the early 2000s commodity supercycle, and most recently during the monetary chaos following the global financial crisis. The reason is simple and surprisingly human. Gold moves first because central banks and institutions respond to fear quickly. Silver moves later because industry and retail investors react once the damage becomes visible. Venezuela's collapse has accelerated that timeline by forcing industrial buyers and governments to reassess where future metal supply will come from in a world that is becoming more fragmented, not more stable. What many people miss is that silver inventories were already tight before Venezuela's situation fully unraveled. Years of underinvestment in mining, combined with rising industrial demand, created a fragile balance. When a shock hits a fragile system, prices do not adjust gradually, they gap higher. Think of it like a dam holding back rising water levels. For years, the pressure builds quietly, unnoticed by most people. Then a crack appears, and suddenly the entire structure is under threat. Venezuela did not cause the silver bull market by itself, but it widened the crack enough for everyone to see the water rushing through. Another layer that makes this moment different is the broader collapse of trust in paper promises. Venezuela's currency didn't just lose value, it lost meaning. When people there stopped asking how many bolivars something cost and started asking how many grams of silver or gold it took to buy food, that wasn't symbolism, it was survival. That psychological shift matters globally because markets are ultimately driven by confidence. When confidence dies in one place, it makes investors everywhere ask uncomfortable questions about their own systems. If it can happen there, could it happen here? And if so, what actually holds value when everything else fails? This is where silver's hidden takeaway begins to emerge. Silver is small enough as a mark that it does not take much new demand to move prices violently. At the same time, it is essential enough that demand does not disappear even in recessions or crises. That combination makes silver uniquely sensitive to geopolitical shocks. Venezuela's collapse has reminded the world that resource nationalism, sanctions, and political instability can remove supply overnight. And when that realization spreads, silver stops being viewed as a speculative metal and starts being treated like strategic infrastructure. We are also seeing a quiet but critical shift in how institutions think about diversification. For decades, diversification meant stocks, bonds, and maybe a little gold. Now, with debt levels exploding and currencies being debased globally, diversification increasingly means tangible assets that exist outside the financial system. Silver fits that role awkwardly but powerfully. It is too industrial to be ignored and too monetary to be dismissed. That dual identity is why it often behaves erratically, and why, when it moves, it tends to overshoot what fundamentals alone would suggest. Ask yourself this question as an investor, or even just as someone trying to protect purchasing power. If a resource-rich country can collapse so completely that its money becomes worthless, what does that say about currencies backed primarily by debt and confidence? Silver does not rely on confidence. It relies on physics, chemistry, and utility. It conducts electricity whether governments are stable or not. It stores value whether markets are calm or panicking. Venezuela's tragedy has forced that reality back into the collective consciousness of the market, and silver is responding accordingly. The early stages of this move are often confusing. Prices surge, pull back, and surge again. Commentators argue about manipulation, bubbles, and fundamentals. This noise is not a sign that the move is fake. It is a sign that the market is repricing something it previously misunderstood. Silver is being repriced not just as a commodity, but as a signal that supply chains are brittle, that currencies are fragile, and that political risk is no longer an emerging market problem. It is a global condition. What makes this moment especially important is that most people will only notice silver after it has already moved far higher. By the time headlines scream about record prices, the underlying shift in thinking has already occurred. Venezuela's collapse is one of those inflection points that seems isolated until hindsight reveals it as part of a much larger pattern. The pattern is one of declining trust, rising scarcity, and a renewed appreciation for assets that cannot be printed, frozen, or redefined by policy decree. As silver rockets higher, the real question is not how high it can go in dollar terms, but what that rise is actually telling us about the system we are living in. Venezuela is not the cause, it is the warning flare. Silver is not just reacting, it is transmitting a message. And that message becomes clearer when you stop looking at charts and start looking at history, incentives, and human behavior. Because once you understand what silver is signaling, the story stops being about Venezuela alone and starts becoming a mirror held up to the entire global financial system, revealing stresses that have been building quietly for years. What happened in Venezuela is extreme, but the mechanisms behind it are not unique. Currency debasement, exploding debt, political promises funded by printing rather than productivity, and the gradual erosion of trust are patterns repeated throughout history, and silver has an uncanny habit of reacting just before those patterns become impossible to ignore. To see why this matters now, it helps to zoom out and look at how silver behaves during periods of systemic strain. Silver is often described as gold's volatile cousin, but that description misses the deeper point. Gold reflects fear, silver reflects stress. When systems are merely unstable, gold rises. When systems are strained by real-world constraints like energy shortages, supply bottlenecks, or geopolitical fragmentation, silver begins to surge because it is embedded directly into the functioning of modern civilization. Venezuela's collapse didn't just scare investors, it reminded industries and governments that access to real materials is not guaranteed. Take energy as an example. As the world pushes toward electrification, solar, electric vehicles, and grid upgrades, silver demand has risen steadily. Each solar panel requires silver for its conductive properties. Each electric vehicle uses more silver than a traditional combustion engine car. These trends were already in motion, but they assumed stable global trade and predictable mining output. Venezuela's breakdown, alongside other geopolitical flashpoints, has challenged that assumption. When supply chains are disrupted, the price of indispensable materials doesn't drift upward politely, it reprices violently. At the same time, the financial side of the silver market has been undergoing its own transformation. For years, paper silver markets dominated price discovery. Futures contracts, unallocated accounts, and derivatives created the illusion of abundant supply. But when real-world stress increases, investors and institutions start asking uncomfortable questions about delivery, counterparty risk, and physical availability. Venezuela's experience with frozen assets and inaccessible reserves has added urgency to those questions. It has shown that ownership on paper is not the same as control in reality. This is where the hidden takeaway becomes clearer. Silver's rise is not simply about scarcity, it is about sovereignty. In Venezuela, citizens learned painfully that access to real assets mattered more than official balances. On a global scale, governments and institutions are beginning to internalize a similar lesson. Strategic resources, her energy, food, or metals are being reclassified from commodities to national security assets. Silver, because of its role in defense, technology, energy, sits squarely in that category. History offers powerful parallels. During the collapse of the Roman Empire, silver coinage was steadily debased to fund military and political promises. The decline in silver content mirrored the decline in institutional trust. In the Weimar Republic, silver and gold became lifelines as paper money disintegrated. More recently, during the inflationary 1970s, silver surged not because people suddenly loved metals, but because they no longer trusted policymakers to protect purchasing power. Venezuela's collapse fits cleanly into this historical rhythm, acting as a modern echo of an ancient cycle. What makes today different is speed. Information travels instantly. Capital moves faster than ever. When one system cracks, others feel the tremor immediately. Silver's relatively small market amplifies this effect. Unlike oil or copper, which have massive, deep markets, silver can be pushed dramatically by marginal changes in demand. A few large buyers deciding they want physical exposure rather than paper claims can shift the entire landscape. Venezuela's situation has nudged more players toward that mindset, accelerating a process that might otherwise have taken years. There is also a psychological component that cannot be overstated. Venezuela shattered the belief that resource wealth guaranteed stability. For decades, the assumption was that countries rich in oil, gold, or minerals would always find a way to muddle through. Venezuela proved that mismanagement and loss of trust can overwhelm even the richest geological endowment. That realization has changed how investors assess risk globally. It has made them more sensitive to warning signs and more inclined to seek assets that sit outside political systems altogether. Silver benefits directly from this shift because it exists in a strange middle ground. It is not controlled by central banks to the same extent as gold, yet it is not purely industrial either. It straddles both worlds, which makes it an effective hedge against multiple failure modes. If inflation accelerates, silver tends to rise. If industrial demand surges due to energy transitions, silver tends to rise. If geopolitical fragmentation disrupts supply, silver tends to rise. Venezuela's collapse touched all three of these forces simultaneously. Consider the analogy of a canary in a coal mine. The canary doesn't cause the danger, it reveals it. Silver is playing that role now. Its price action is not random or speculative madness. It is reacting to deeper pressures building beneath the surface of the global economy. Pressures related to debt saturation, declining energy returns, political polarization, and the weaponization of finance. Venezuela experienced these pressures in concentrated form. The rest of the world is experiencing them more slowly. Why? But the direction is the same. Another subtle but crucial factor is the behavior of emerging markets. Many countries watched Venezuela and quietly adjusted their strategies. Some reduced exposure to dollar assets, others increased reserves of tangible commodities, some sought bilateral trade arrangements that bypassed traditional financial channels. These moves may seem small individually, but collectively they reduce reliance on paper systems and increase demand for real goods. Silver, again, sits at the intersection of these trends, absorbing pressure from multiple directions. As silver prices rise, skepticism naturally follows. Critics point to past spikes and crashes, warning of bubbles and speculation. That skepticism is healthy, but it often focuses on the wrong question. The question is not whether silver will pull back or fluctuate, it always does. The question is whether the underlying drivers have changed. Venezuela's collapse suggests they have. It has highlighted vulnerabilities that were previously theoretical and made them tangible, emotional, and impossible to ignore. Think about how quickly perceptions can shift. Before the collapse, Venezuela's problems were seen as distant and self-inflicted. Afterward, they became cautionary tales discussed in policy circles and investment committees worldwide. Silver's move reflects that shift in perception. It is pricing in not just one country's failure, but a broader reassessment of risk in a world where political and financial stability can no longer be taken for granted. This brings us closer to the heart of the hidden takeaway. Silver is not just a hedge against inflation or a play on green energy. It is a hedge against complexity itself, against systems so interconnected that a failure in one place cascades unpredictably elsewhere. Venezuela's collapse was a localized event with global implications, and silver responded because it is deeply embedded in the real economy in ways that abstractions, like derivatives and digital balances, are not. As this realization spreads, silver's role evolves. It stops being treated as a short-term trade and starts being viewed as strategic insurance. Insurance not against any single outcome, but against uncertainty itself. That is a powerful shift, and it rarely happens quietly. It happens with volatility, debate, and dramatic price movements that confuse those focused only on charts. The story is still unfolding, and the most important insights often come not from watching prices, but from watching behavior. Who is buying, why they are buying, and what fears or expectations are driving those decisions. Venezuela has injected a new layer of urgency into those calculations, pushing silver further into the spotlight, and the implications of that shift extend far beyond the metal itself, because the final layer of this story is not about price targets or short-term forecasts, but about what silver's reaction to Venezuela's collapse ultimately teaches us. Outpower, control, and the quiet return of physical reality in a world that has lived too long inside abstractions. When systems are stable, people trust symbols. Numbers on screens, promises written into contracts, assurances from institutions. When systems fracture, those symbols are questioned, and reality reasserts itself in the form of things you can touch, measure, and use. Silver sits firmly in that category, and that is why its rise carries meaning far beyond a typical commodity rally. Venezuela showed the world what happens when the gap between financial promises and physical capacity becomes too wide to ignore. Oil reserves meant nothing when infrastructure failed. Currency meant nothing when production collapsed. Official prices meant nothing when shelves were empty. What retained value were tangible goods, metals, food, and anything that could function outside the formal system. This is not theory, it is lived experience, and markets learn from lived experience faster than from academic models. Silver's behavior suggests that this lesson is being absorbed more broadly than many realize. One of the most overlooked aspects of silver is how difficult it is to replace. If gold disappears from the market, it creates a monetary problem. If silver disappears, it creates a functional problem. Electronics fail, energy projects stall, medical technologies become more expensive, and military supply chains are disrupted. That makes silver strategically sensitive in a way few other materials are. Venezuela's collapse has reminded policymakers and corporations alike that access to critical inputs cannot be assumed indefinitely, especially in a world trending toward fragmentation rather than cooperation. This is where the hidden takeaway becomes almost uncomfortable. Silver is exposing the fragility of a system that has relied on just-in-time supply chains, financial leverage, and political stability as if they were permanent features of reality. Venezuela is proof that they are not. When confidence breaks, the adjustment is not smooth, it is violent. Silver's volatility is not a flaw, it is a reflection of that underlying instability. It is reacting honestly to a dishonest system, and that honesty can look chaotic. There is also a generational shift happening beneath the surface. Younger investors, having lived through financial crises, pandemics, and geopolitical shocks, are less trusting of institutions than previous generations. At the same time, emerging markets are seeking ways to protect themselves from external pressure and financial weaponization. These forces converge on tangible assets. Silver, because it is accessible compared to gold and essential compared to many other commodities, becomes a natural focal point for that shift. Importantly, this does not mean silver moves in a straight line forever. History shows that silver bull markets are emotionally demanding. They feature sharp rallies, brutal corrections, and long periods of frost. Ration. This is why most people miss them or abandon them early. But the big moves tend to happen when the underlying narrative changes, not when the chart looks perfect. Venezuela's collapse contributed to such a narrative change by turning abstract risk into visible consequence. Ask yourself what happens next if similar stresses appear elsewhere. What if another resource-rich nation falters? What if sanctions expand? What if debt markets seize up? What if energy transitions accelerate faster than supply can respond? Each of these scenarios increases the value of materials that are both scarce and necessary. Silver sits quietly at the center of that intersection, absorbing pressure without fanfare until it cannot anymore. This is why focusing only on price misses the point. Price is the messenger, not the message. The message is about resilience, about what holds together when systems are strained. Venezuela's tragedy stripped away illusions and left only essentials. Silver's rise suggests that markets are beginning to think in similar terms, even if they are not yet willing to say it out loud. There is a tendency to view events like Venezuela's collapse as isolated failures rather than signals. That tendency is comforting, but dangerous. History shows that systems rarely fail all at once. They fail at the edges first, in places considered peripheral. Silver's reaction indicates that what happens at the edges eventually reaches the center. The metal is not predicting doom. T is reflecting risk, and risk has been systematically underpriced for a very long time. Ultimately, the hidden takeaway is not that silver will solve these problems, but that it reveals them. It reveals the limits of paper wealth, the importance of physical inputs, and the consequences of ignoring structural fragility. Venezuela is not the blueprint for the future, but it is a warning written in bold letters. Silver read that warning early, and it is responding in the only language markets truly understand, because what Venezuela's collapse has done is pull back the curtain on how fragile modern systems can become when trust, production, and reality drift too far apart. Silver's surge is not just a reaction to one country's failure, but a response to a world waking up to scarcity, geopolitical risk, and the limits of financial engineering. As both an industrial necessity and a monetary refuge, silver reflects stresses that are building quietly across the global economy. The real lesson is not about chasing prices, but about understanding why tangible assets regain importance when confidence fades. Venezuela is the warning, silver is the signal, and the takeaway is a renewed awareness that in uncertain times, what is real matters more than what is promised.